Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is What's Hot. Well, the Q2 earnings season has just wrapped up and India Inc. has actually reported healthy revenue and earnings growth of 9 and 16% respectively on a year-on-year basis for Q2 FY26. And this can be actually inferred from the about 2,400 companies that have already reported their results as well. Now, when we look at excluding the banks and the financials, the biggest chunk, the growth metrics further increased to 9% and 22% for revenue and profitability on a year-on-year basis as well. Now, while these could be seen as strong numbers enabled by rebound in the economy, the growth rate is also partially influenced by the base effect as well. Remember, in Q2 FY25, the earnings for the same set of companies had actually declined by around 18% as well. So we'll try and understand and decode how the earnings season has gone by for all the key sectors and what do we expect for H2 of FY26 in this special edition today. Joining in on this special edition is our market master, Mr. Sudip Bandopadhyay, Group Chairman of Indie Trade Capital, joining in on this program with us. Warm welcome to you, Sudip ji, and thank you so much for taking the time out for this discussion. Now, overall, what we are given to understand is that probably Q2 has panned out better than the kind of expectations that we had gone into with. No big negative surprises. So I want to understand whether you're happy with the Q2 earnings as they have come up. And while it's still premature to ascertain the impact of big reforms like GST revision, the initial signs, do they appear to be healthy?
Oh, absolutely. You're 100% right. I think nobody in the market expected the kind of numbers which we did see. By and large, the results have been a positive surprise. The expectations, of course, were pretty subdued with heavy monsoon and a lot of other challenges in the global market as well as domestic. But the Indian corporates have come up with a fantastic set of numbers, I must say. And some of the sectors have really surprised the market.
Absolutely. Now, Sudipji, let's try to understand and decode sectorally as to how some of the earnings have come in. I think one of the big positive surprises that came in was from the refining space as well. Lower crude prices, better than expected improvement in GRMs. They enabled these companies in this sector to post strong growth in profits. And this was also from a combination of higher revenue and higher profit margins that the companies have posted. And also as a risk that was being seen of discontinuation of the Russian crude oil is seeming to be unlikely, at least at this point in time, having any significant impact going forward from year two. So how do you assess the oil and gas refining space as large, sir?
Well, I think the numbers speak for themselves and they were pretty good, and you're absolutely right. Low crude oil prices and the GRM improvement definitely helped the companies. There were no major challenges as far as inventory also is concerned. Normally you get to see in a falling crude oil kind of an environment, you get to see inventory losses, but I think that also was managed pretty well by and large almost all the refining companies. So things were pretty good. I must also add to this, as far as the marketing companies, there were no change in the prices at the pump, and that did lead to a lot of recovery, a lot of increase in profitability from the marketing point of view. So I think it was all good. But I will just add a word of caution, Shakshi, here is that this sector is extremely volatile. So yes, Q2 was good and Q2 was better than expectation, but doesn't mean it will translate into some similar, or you can extrapolate and come to some kind of a conclusion on Q3 and Q4. I think we have to be careful there.
We have to be careful there. Again, talking about more commodity spaces, cement and steel were also among the big contributors of India Inc.'s growth in Q2. Both these sectors saw strong demand, clear volume rebound that is being seen. Cement prices improving also helped. Steel prices are now recovering more slowly even though. But, when we talk about the high operating leverage and a weak base, they've driven the strong earnings for this time around for both these sectors, especially for cement. Now, I want to understand the ongoing consolidation that's taking place in the cement industry, which is adding further momentum as well. How do we see these two sectors at the end of Q2 and what is in the offing, sir?
Well, I've been very positive on cement for quite some time. I think a couple of times I mentioned in your program to be viewers as well that I'm bullish on cement, and I continue to maintain my view. The numbers speak for themselves. I think if you look at by and large most of the cement companies, they came up with fantastic set of numbers. The monsoon is normally a lean season, but in spite of that, I think the volume growth in itself testifies to their resilience. Look at the cost as far as the cement companies are concerned. They've all worked on the cost in a big way, and the margin increase to a great extent has been contributed by cost efficiencies. Of course, raw material prices also had come down, coal prices were subdued. So all this did help the cement companies come back with a fantastic set of numbers. But on top of that, I think we have to understand the dynamics going forward as well. And I think you alluded to the demand, and I think it's absolutely right. The demand supply scenario does now favor the cement companies. The demand is very strong and is expected to remain strong in the near future as well. Look, the government is spending huge amount of money on capital expenditure on roads, ports, infrastructure, housing and whatnot. So with all this requiring significant amount of cement, I think the demand for cement is going to remain very, very strong. The private consumption also is increasing, and the dynamics on ground does favor the existing cement companies with large capacities. So the large cement companies, whether it's an Ultratech or a Ambuja or an ACC, I think all of these guys will do exceedingly well even in the coming quarters, and that's something which I think I'm reasonably confident of.
Okay, please continue, sir.
Yeah, as far as steel is concerned, I think again it's a good story. Domestic demand has been pretty robust, and that has led to recovery in prices. Also, the government continuing to extend the the anti-dumping kind of a duty for a further period has helped and cool the nerves as far as the industry is concerned. So again, I think with the industrial activity picking up in a big way, construction picking up in a big way, the demand for steel is increasing and will continue to remain robust in the near future as well. We are out of the monsoon lean season, so now the next 2 quarters, Q3 and Q4, we expect demand to continue to remain robust, and the steel prices will also firm up even from here on. So I think from this steel point of view, also I think we can expect even better results in the coming quarters.
Any key names here, like you had pointed out, some large caps like Ultratech, Ambuja and ACC for cement. Any key names that you are more bullish on within the metals and mining pack?
Well, I do like Tata Steel. I mean, they have that international component which sometimes creates a lot of challenges, but I think things are falling in place there as well. Domestic business has been doing very well and will continue to do well. JSW also can be looked at. I think they are also doing well and efficient. Both are very efficient. Tata Steel, of course, is one of the most efficient steel producers in the world as far as the Jamshedpur operations are concerned. So yes, they will benefit. Margins will be good and probably will keep improving.
Okay, got that. And we didn't ask you for the refining oil and gas space. Which part of the oil and gas and refining space are you more bullish on, sir, for the H2?
Well, Shakshi, I think we have crossed the first half of the year. In the second half, I think generally the oil demand remains strong, but I think there is too much of volatility in this entire space because of global headwinds and challenges. So I will be very cautious. This is a good place for the traders to get in, but I think fundamentally I'll be very careful in recommending stocks. One stock which, in spite of not such a good performance from a long-term perspective, I do like is ONGC. I think the potential is huge. They haven't played up to their, lived up to their potential yet, but the scope is huge, and I think at some point of time in the near future, I think they will start performing exceedingly well. And this is directly related to global crude oil prices and what's happening there. So volatility will remain, but from a long-term investor's point of view, I will prefer ONGC, not the marketing companies.
Fair point, sir. So that's the commodity basket considered. Let's move on to now talking about the auto sector, one of the buzzing sectors of late. Strong exports, festival demand, and just about slight indication of that GST 2.0, which has boosted the performance. And even before the rollout, we did see the stock prices also perform pretty well, easing some of the earlier signs of fatigue after multi-year upcycle. Now, premium model launches is what we are seeing speed up for a lot of companies. Rising EV EV penetration. That's also expected to support demand going forward from here. Companies are also gaining with two-wheelers and four-wheelers, exports now picking up pace as well. Although the supply constraints that we were talking about for a fairly long bit of time, rare earth minerals, we don't know whether that could continue to affect the EV growth going forward from here. So that's something that we will need to watch out for. But as per you, sir, how would you sum up the Q2 earnings? What stood out for you and what do you look forward to?
Well, by and large, the Q2 earnings were on expected lines. I don't think I will say they were exceedingly good or bad. They're by and large on expected lines. Of course, Tata Motors passenger vehicle segment, there were a lot of disappointment because of the commentary, more than the actual results. The commentary and the forecast has been pretty subdued, and that has disappointed the market. But by and large, they're in line. But having said that, I would say that I did like the Mahindra numbers and Mahindra commentary. I think M&M has been doing exceedingly well in the SUV segment. Their electric vehicles have started picking up in the market, though numbers are not significant yet. Tractors have recovered, and they are coming back with good set of numbers, and it's expected with rural income increasing, monsoon being good, we expect tractor sales also to go up. So M&M is one company which we have been bullish on, and we continue to remain our positive bias. You alluded to the exports being good. Yes, the exports has been also good for as far as two-wheelers are concerned, and even Maruti is concerned. I think as far as two-wheelers are concerned, the export market is adding one more dimension. Bajaj always had a good export business, but I think the other companies also have got into that, whether it's a TVS or even Hero MotoCorp. I think they are also getting aggressive in the export, which is getting them the incremental business volumes. But overall, we are a little cautious considering the valuation at which these stocks are trading. If I have to pick up one stock from the future point of view, I'll probably go and pick up Hero MotoCorp, simply because of the fact that rural demand had been subdued in the past few quarters. But things are improving, and we expect it to further improve in the marriage season. So Hero MotoCorp, which caters to the lower end of the market, should do well in the coming quarters.
Okay, fair point. So there you have it, an understanding of how the auto sector is going to be panning out. Let's actually look at now the pharma space that also managed to deliver solid growth. Many companies with a significant US exposure now are actually bracing for the end of exclusivity period for generic Revlimid, a key driver of recent gains for players like Dr. Reddy's and Sun Pharma, the larger ones. However, notwithstanding the near-term impact, on the long-term basis also US pipeline assets should be differentiating factor as well for the industry, including big opportunities for diabetes drugs as well. The contract manufacturing segment has also reported some sustained momentum there in inquiries, revenue generation, reported by companies like Divi's, Laurus or Newland Labs, for instance. Overall, Sudip sir, if you could help us understand, where do you see more opportunities going forward after the set of earnings that have come in?
Well, the earnings, as you rightly said, were probably much better than what was expected. Things have started looking up in the US as well for by and large the players, and I was surprised to see pick up in US business as well as South American business for many of these companies. But if I have to look at the future, I think I will focus on domestic business. I think that's one segment which is not talked about much, but its solid growth is being demonstrated by the existing players in the domestic market. And companies having rock solid domestic business have been doing very well and will continue to do very well. That's our view. We do like Mankind Pharma, which has got about 95% domestic business and only 3-4% exports. So we have to pick up these companies, and they are away from the shenanigans of the world market, trade war and tariff war. So it is always a safer bet to focus on domestic manufacturing. Now, as far as the large pharma companies are concerned, which have got significant presence in US, while the results have been good, I will still urge a bit of caution there.
Okay.
Valuations are not cheap, and two, the volatility still is too much.
Absolutely. Let's also now focus on the banking space, the large space there. there was still, of course, the sector remains very promising. It has performed on the stock market so far, especially led by NBFCs and private sector banks. But remember, this sector was also marred by one decline in the net interest margin since the start of the rate cut cycle last year. That is now hopefully nearing its end. But so far, to an extent, the factors such as easing liquidity, treasury, and fee income have now enabled banks to counter this in Q2. But the credit growth is also expected to pick up after slowing to 10 to 12% across large banks. Corporate and retail banks are also expected to drive. These segments are expected to drive the credit growth for the after the recent GST cuts and the tax measures as well. And overall asset quality seems to be stable, at least for now. What's the broader sense? Will we continue to see slight weakness on the banking space in H2 as well, sir?
I don't think so. I think, BFSI definitely is one area of the market which has been doing reasonably well and will continue to do well. Let's divide the entire BFSI into a few pockets, and then I think things will become a little more clearer. In a falling interest rate scenario, I think, the guys who are borrowing benefit more than proportionately, and NBFCs rather than banks will be the bigger beneficiaries, and they have been. Look at the NBFC numbers, whether it's a gold loan companies, whether it's in other segments, I think they have been doing exceedingly well and will continue to do well. We expect further interest rate cuts in the near future from RBI, considering where the inflation is. So under the circumstances, the margin pressure on the banks will remain because of the falling interest rate scenario, at least for some time. You're absolutely right. Asset quality across the board has improved significantly, and that gives some amount of comfort. But even Q3 with a falling interest rate and one more interest rate cut likely in December, I think we will see some bit of margin pressure on the banking space. But NBFCs will continue to do well. I will point out one more thing. There is a significant valuation gap between even BFSI segment, particularly in banks, and between private sector banks and public sector banks. And I think there, at some point of time, this gap to an extent will get bridged. So one should definitely look at some of the efficient PSU banks, and all of them are improving quite a bit. Even the largest bank, which is SBI, trades at about 1.1 time book, whereas an NBFC like Bajaj, Finance trades at 5 to 7 time book, depending on when you are taking the valuation. So there is a rationale and reason for valuation up move as far as PSU banks are concerned, and one should look at that.
Okay, and when I want to ask you, now there is a lot of buzz off late on the PSU banking space as well, with the upcoming triggers that everybody is betting big on, consolidation, mergers, even increased ownership of FIIs. How are you looking at the opportunities that will present themselves within the banking space, and how should investors be focused on between earnings and a lot of these changes, fundamental structural changes that are taking place?
Well, Sakshi, the merger is good for overall the banking space and the PSU banks, but it's in the realm of speculation. Who will merge with whom, when it will happen? It's very difficult to comment and predict. It will be good for the industry. But as an investor, as a market participant, if I have to look at smaller banks who may be the target for merger into a larger bank, I would look at efficient banks and banks which have got the potential to get merged. And a couple of banks stand out. Central Bank of India does look good at current valuation. Bank of Maharashtra, probably one of the best PSU banks, does look good at current valuation. Now, some of these banks, even without getting into the specifics of who will merge with whom and when, I think can be picked up at current level for gainful investment.
Okay, got that. Let me now come to the IT sector as a whole. That continues to face, some weakness, weighed down by the tariff-related uncertainty, shifting client spending amid AI-led disruption. Revenue growth is also inching up sequentially, aided modestly by the weaker rupee as well. Discretionary spending remains still uncertain, even though project deferrals appear to have now stabilized. Both large and mid-tier firms are rapidly now retooling their workforce for AI, but earnings impact of this structural shift will actually need close monitoring even when we go forward from here, sir. So how would you assess IT sector at this juncture?
Well, you're absolutely right. There are a lot of things happening in IT. A lot of seismic shift, I would say, is happening. AI has been a big influence on the entire overall technology space, and we get to see it getting in its full form, full blown form in US markets, where the AI related stocks command humongous valuation. Now, unfortunately, the Indian IT companies have missed the bus as far as AI is concerned, to a great extent, I would say. And I think they are struggling in terms of valuation and in terms of business as well in US. To my mind, I think their margins also will be under pressure. With AI deployment becoming the most important component of IT projects going forward, and Indian IT companies not having any proprietary AI tools, I think will be at a disadvantage vis-a-vis some of the global peers, and their margins will suffer. They will, of course, use AI tools effectively and deliver services, but margins will take a beating. So we have to be careful. Also, the fact remains that in US things haven't yet stabilized. I think there is too much of volatility, and the large corporates have been holding back on spending. There is no two ways or second opinion about it. Spending is being held back in a big way, and that is affecting Indian IT companies' order flows. So both these two things doesn't augur well for Indian IT companies going forward. So I would generally avoid IT. However, if you want to get into IT, look for niche areas. Let's say travel and tourism. Globally, travel and tourism is in a major boom. Now, if travel and tourism is in a boom, the companies catering to IT companies catering to travel and tourism sector will do well and have been doing well. So, RateGain Technologies, an Indian IT company catering to this segment. There have been fluctuations in earning from quarter to quarter. They have been acquiring companies, but I think if you take a couple of years view and buy RateGain, I think that should be good. Buy Coforge, again, they have a large travel and tourism related business, has been doing exceedingly well. So you have to pick up these kind of niche areas which are doing exceedingly well, and identify service providers in the technology space who are catering to those segments.
Absolutely. Let's actually come to the last sector that we will focus on, and then we will take an overall view going forward from here. FMCG sector, sir, that's continued to post weak results. The GST cut has aided a portion of the sector, but it did not play out in this quarter. We'll have to wait for Q3 and Q4. FMCG volume growth is still not good across the companies and the entire sector. It's only selectively getting better. How are you looking at this sector, looking at the reorganization, new product focus to counter high competition, keeping the margins pressure as well, and dealing with that at this point in time on the FMCG space?
No, you are right. I think the results have not made people happy. They're rather disappointed with the FMCG numbers. The GST cut is should definitely be a boost for consumption going forward, but it won't be the kind of boost which you expect in a consumer durables or a automobile segment. Look, because the prices will come down marginally, you won't go and start consuming more biscuits or more atta or more rice. One has to be realistic. There can be some increase, but not any significant increase in consumption on FMCG items. There can be value movement across the value chain, and higher value products may start getting sold little more. So the kind of volume pickup we expect in consumer durable, automobiles, and some other segments should not be expected in FMCG on the back of GST. However, the question is, there were a problem in demand as far as rural India is concerned, and even urban India. Now, with festive season kicking in and things generally improving, with monsoon being good, agriculture being good, inflation having come down, I expect Q3, Q4 to be much better from a FMCG point of view and volume point of view in particular. So Q3, Q4, probably we will see the volume recovery after a very long time, but in general from the FMCG segment, and things should start improving from Q3, Q4. Now, amongst the companies, I see potential in Godrej Consumer. I think there has been initial signs of their business, starting to pick up domestic as well as international. They have a significant international component. Marico numbers were by and large as per expectations. I would like to see some more improvement in most of the other FMCG companies before commenting on them.
Okay. At the end of Q2, Sudip sir, for you also, have you seen the earnings downgrades now coming down sharply vis-a-vis the previous quarter this time around, and anywhere where you also had seen clear cases of earnings upgrades?
Well, I think you're absolutely right. I think the analysts are by and large bullish on Q3, Q4. Q2 has surprised them positively. One segment which we didn't discuss, and I think has surprised everybody, was the paints. Look
Yes.
at the kind of subdued demand and kind of challenges the paint industry, the intensity of competition which they were facing. But look at Asian Paints, the kind of numbers they came up with, that did beat everybody's expectation in the street. And even Berger Paints and others. So probably the competition intensity is coming down, and the leaders are re-establishing themselves as far as the business and revenue and profitability is concerned. The challenges are still not over, but it was a pleasant surprise as far as numbers are concerned. Overall, as I mentioned earlier, Q2 were positive, much better than expectation, and there is a positive expectation for Q3 and Q4 from here on.
Absolutely. Well, on that note, we will wrap up our earnings conversation. But Sudip sir, when we look at H2, what are the triggers that you may be looking out for that will point out to a stable earnings scenario and a lot of stock markets related uptick that we could probably see? What could be those triggers that we need to now watch out for beyond the earnings?
Well, I think the biggest trigger we all know is a trade deal. I think, more than anything, it is a big sentiment positive if and when the trade deal happens. And this will trigger a lot of FII interest back in India, which will lead to significant increase in inflows and take the market up to a different level altogether. So I think that's the one single largest trigger which we can expect. The second trigger I have been hearing murmurs here and there is that the next set of reforms. I think a lot of senior government functionaries have been hinting at the next set of reforms which are expected to come in sometime soon. This is post the GST. GST was the first reform measure which the government took post the tariff war, trade war. And the second set of reforms are expected, are believed to be, in the works and will come. Now, if there is some significant, measures which are announced by the government, that can again work as a trigger. We don't know that is going to be, how that is going to pan out, but the expectation definitely is gradually building up on some kind of reform.
Okay, fair point. Well, all right, on that note, thank you so much, Sudip ji, for being with us on this very special edition. I'm sure this is a very comprehensive edition where you've got to understand from various sectoral standpoint viewers that how the earnings have panned out and what is on, going forward from here in H2 and what do you need to watch out for. As always, we always appreciate your presence, sir. Thank you so much for all those wonderful insights. Alright viewers, we'll wrap it up on that note as far as what's hot is concerned. Market coverage continues on the other side. Right now, if you look at the Nifty, it's at 25,935. Largely on a positive note, the broad-based buying continues, barring IT and metals. Rest of the sectors are actually contributing higher. PSU banks that we also broadly discussed in our current show in What's Hot has again picked up pace 1.5% higher. You have a lot of names like Shriram Finance, Bajaj Auto, Axis Bank, Kotak Mahindra Bank, Bajaj Finance, all of them up and about. So the NBFC space that Sudip ji was also talking about is continuing to be in a thick zone. Apart from this, in the PSU space, you have the names such as RVNL, BPCL, IRFC, so railway related stocks also buzzing. You have defense related stocks also buzzing in trade. So the entire space seems to be in a positive zone. So we yet again are looking forward to starting another week on a positive note itself. So stay tuned with us. Market coverage on the other side and your daily calls questions will be answered at 12 noon. Stay tuned for that too.